Welcome back everyone to Vox Markets. My name is Paul Hill and I'm delighted again to be able to speak to Judith MacKenzie of Downing Asset Management, one of the most accomplished and active UK small cap fund managers. So welcome, Judith.
Good to see you again, Paul.
Yeah, I think when we spoke last time in September, Downing had built up quite a large cash position, or relatively large cash position, given its caution going forward, and rightly so, in terms of the schools and universities reopening. Since then, we've had 3 breakthrough vaccine treatments being announced, and the markets have rallied. What's your top level view about the stock markets for 2021 and beyond?
Well, I'm naturally pessimistic. I'm normally quite negative. And, I can't help thinking about the fiscal debt, unemployment that's going to be coming through. And so they do give you quite a lot of reasons to be quite cautious. But after all, it is Christmas time. And fundamentally, value stocks look quite cheap compared to peers, international peers. And what we've been seeing since probably end of August and start of September is there's been quite a lot of corporate activity returning to the market. And I think that really highlights and underlines the quality of some of the value positions in the UK market. So with that in mind, I'm probably slightly more bullish than I would normally be. And actually, these stocks are quite cheap and by any fundamentals. And you've got earnings upgrades returning to the market, or analysts now updating their numbers. And I think with a little bit of clarity on Brexit, whatever that's going to look like, then there's inevitably going to be a return to a focus on UK small cap value, which is great.
Yeah, I mean, I'm just picking through some of your positions. We'll go through that in a bit more detail later on, but just sort of top level, your sort of like, or Downing sort of value position. I mean, look, top level, it looks as though you potentially could have a banner year in 2021, given pent up demand. I don't want to make promises for you because it's impossible to say, but I mean, a lot of them are still sort of like, down year on year, but they're very, very cheap, got niche, strong positions, strong balance sheets, and with pent up demand, low interest rates, and people getting back to work. All those are sort of like, ingredients you'd have thought for the majority of the portfolio to do quite well.
Yeah, I mean, we do what you do, and that is to look at what the normalized earnings are. And that's not taking a 2, 3, 5 year forecast. That's stripping it right back to what the company's been able to do in the past and looking at what kind of multiple it's on now and actually where the sector multiples are. And then maybe overlaying where you think you can get earnings growth coming through as well, whether it's through acquisition or organic. And these stocks are, you can see where the upside is going to come from, and you don't have to be betting on some great change in their business for that to happen. Yeah, so we're quite encouraged.
In that context, then, just one of the companies you've recently bought, which is a fascinating stock. I mean, I've never even heard of it before, and I look at sort of like hundreds of stocks each week, is DBOX, which I think is a sort of like a mobile first media business. It's got 3 sort of like valuable internet real estate, Entertainment Daily, the Daily Mash, which I thought was a dance, but and the Tab, which is a student-orientated mobile property. Can you just walk us through what the investment thesis on DBOX? It's mind you, it's only about 6.5 million market cap, I think.
Yeah, it's about 3.8 million EV, I think. So it's tiny.
Okay.
It's tiny.
Got a lot of cash.
Yeah, it's got a decent amount of cash. So, well, what we quite like about it is cash generation. Very simply, it's a great model because there's around about 70% gross margins and 25% at the bottom line. But you're right, it is absolutely tiny. And actually, what's not nice about these types of businesses is that they get rocked quite a bit by algorithms that come out by Facebook and social media and Google, etc., who always want to try and capture some of the ad market. But actually, if you get scale in this market, then and you start to own your user base and get loyalty there, then you really do create good value. And what you see is that you can sell these businesses on 7.5 times to 9 times contribution. That's the gross margin. And then you look at businesses like Future, who are much, much larger, who's consolidated this kind of space, and they're on 25 times earnings. So the model here, the investment case is really quite simple. It's a buy and build. They recently bought the Tab, which is a great little business, as you say. It's 31 universities throughout UK and capturing most of the student network. So if you can do that and really get closer to your user, then you're adding real value, and you're buying them on 2.5, 3 times EBITDA. And as I say, you can hopefully get a flip at some stage to get 7.5 times contribution. So start of the journey there. I would expect more acquisitions, and they've announced that there's a new chairman going in place, and we've got observer rights on the board as well. So it's going to be a really interesting journey, hopefully quite a short one.
And given its consumer-facing sort of website rather than the B2B one, which usually rely on subscriptions, how easy is it to sort of monetize those properties in terms of, I mean, obviously you can do advertising, programmatic advertising, but it's quite difficult to get eyeball time, isn't it? Unless you've got a really strong niche brand.
Yeah, that's it. I mean, it's interesting because they created Entertainment Daily themselves from scratch because their advertisers wanted to get the eyeballs of, dare I say it, middle-aged women a bit like me. So they created this title about 2 years ago, and now that's their most cash generative title. So you can do it, but you've got to have content, and you've got to have quite unique content, so you're getting unique users coming through. And it's also why, as you say, you need to have something that's quite niche. So therefore the tab that has actually got its own student editorial, almost like a student magazine to a certain extent, it can really appeal to people. So you can't just go out there and just be another Me Too like the Daily Mail. You've got to be generating unique content of some sort. And so therefore going into sort of niche titles, whether it be in, I don't know, angling or specific sports, you can pick up titles like that are maybe a little bit unloved, and then you start putting it through their engine, and you can get advertising revenues coming through quite quickly. So it's not just about subscription. In fact, it's not really about subscription.
And then another one that Downing has recently bought into, which again is on the buy and build, or seems to be strategy, is Venture Life, that I know Gervais Williams and Simon Thompson, Investors Chronicle, love as well. And they just raised, I think it was about 34 million pounds in terms of sort of buying particular businesses. How do you see that one? I think it's sort of like oral care mouthwashes, isn't it, or something?
Well, it did. It caught some of the COVID attention because, I mean, they've been selling mouthwashes for the last 3-4 years, but all of a sudden a mouthwash is supposed to eliminate COVID, which I'm not quite sure if it does or not. But anyway, we see it much more like a mini Alliance Pharma.
Yeah, okay.
And very, very smart, picking up assets that are unloved by bigger companies and monetizing them quite basically. Great manufacturing base, good capacity within their manufacturing within Italy, and then a good distribution network as well. So it's quite a simple business model. And it's a management team that have been there and done it before. So I mean, always quite wary about buy and builds to a certain extent, but they had some very clear targets that they could talk about, and that we believe they're going to hit on quite quickly. So we're not really too worried about the rating there at the moment. It's a business that's capable of about £75 million top line and a really nice 25% margin once you start getting the operational efficiencies coming through. So, you can see 200p on that one quite easily in the next year or so.
Yeah, and how easy is it to sort of take a sort of like cash cow brand, a heritage brand, and then make it into sort of like a shining star? Because a lot of the big sort of like the big pharma companies and the over-the-counter ones, and also some of the sort of like your P&Gs and your Unilevers of this world, are concentrating on tier one premium, power brands, I think they call them, and therefore they're discarding a lot of these smaller niche brands who are not going to give them the scale, which gives the opportunity, no doubt about it. But it is inevitably quite difficult to get organic growth in a almost like a cash cow type brand. I mean, you just look at it sort of like, I don't know, Margarine and Bird's Eye and people like that, where it's just you need a lot of marketing dollars to be able to push it.
Well, it's I think it's a combination of things, because some of these smaller retailers are actually quite keen to get a higher margin product on their shelf. So a Listerine or whatever will deliver them not much margin, but you get something that's a little bit more niche, but you can put on the second tier of the shelf, and you might actually be able to grab, the retailer can grab almost double the type of margin. And then if you get a smart operator like Venture Life, who've got the capability on the manufacturing side, you can then grab back margin there as well. So instead of just being a contract manufacturer for somebody else and giving it away, they can keep it themselves. So you're right, it's not easy, but I suppose that distribution side of things has been built up within Venture Life now over the last sort of 3 or 4 years, well, more than that actually. It's quite well established. So it's not just like plugging something new into it. you've got to be quite cautious as to what distribution channels you're using, and not frustrating them by any means. But it's definitely there to do. And as you say, there's lots of latent assets that are sitting around ready to get picked up.
Yeah, and then another one on the buy and build sort of like strategy is Avingtraz, which is a sort of like a mini Melrose. And I know Chris Mills of Harwood Capital is really sort of like backed this, and it's got a very good chairman, I think Roger McDowell, who runs it. Numerous divisions. It's been hit a bit obviously by COVID, but still very cheap. Looking for sort of a bounce with pent up demand with sort of projects and customers coming back, I guess, in 2021.
Yeah, I mean, there's some nice dynamics there. You've got the Hinkley Point project that clearly is benefiting their business in booths that they bought a couple of years ago. And then, but as you say, it's just a really well-run business. We've backed Roger in another couple of situations. In fact, he's in another business of ours, Flowtech, that's within.
Yeah, we'll come on to that in a moment.
okay, you're coming to there, and also Hargreaves, and also obviously Chris Mills is an EKF. So it's a nicely incestuous market that we operate in. But again, coming back to people and management teams, these are very good operators that just know how to run industrial businesses. Yeah. And they're also quite good at disposing of them at the right time as well. So they're not scared about disposing of assets. So yeah, Avingtrans is one just to tuck away, I think.
Yeah, and it's the model now, sort of buy and build. It's sort of like, I mean, you hear these sort of like claims that the private markets are sort of like, very expensive compared to the public markets, and therefore, you'd think that these sort of private equity boys, that model of buying listed companies and taking them private made sense because you can arbitrage the multiple. But going the other way, you need to be really astute in terms of to buy privately cheap companies and then bring them onto the market and get a higher multiple, because that used to be the case sort of 30 years ago. But nowadays, certainly in the tech sector, it's the other way around, isn't it?
Yeah, certainly in tech. I mean, you get little pockets, don't you? The areas that are quite hot at the moment are food services and general sort of tech and software, anything with a reoccurring revenue that private equity seems to be all over at the moment. So it's quite difficult to maybe buy in those areas. But then you get down to the mucky kind of widget manufacturer, then actually you can probably pick up things and get that multiple arbitrage quite nicely. So I think you're right. Generally, private equity has been quite active, and that's both a bit of a threat and an opportunity for buying builds, I think.
Yeah, and then moving to another one you've got, which is basically DX Group, which is a sort of like I think it's a delivery transport company, sort of like parcels and envelopes and logistics and all this sort of stuff. Is this a mini DoorDash by any chance? Can it do food delivery as well?
Well, I don't think so. No, well, everybody's ordering online for Christmas, aren't they?
Yeah, they are.
Online anyway. And they specialise in opera parcels. But this is probably one of the best executed turnarounds that I've ever actually seen. And I've got to admit, when they came to us 3.5 years ago, I was really cynical as to whether they would actually deliver on their plan to improve margins, because it's a really mucky business, as you can imagine.
Yeah.
At that point, I think kind of 0.5% margin businesses where they did make money, and now that's gone up quite dramatically. In some areas, it's up to 6 or 7%. So the share price has done well. It's and it looks on paper, it probably looks quite expensive. But there's the final parts of that turnaround that they're delivering, and they've got the nice tailwinds at the moment of everybody ordering online.
Yeah, and is that a recurrent theme of sort of the thesis for Downing, self-help sort of businesses that are temporarily sort of like going through a challenge period, need a bit of sort of like Downing support or shareholder support or even new management, but the sort of the control, their destiny is in their own hands, and therefore it means that they can do a lot and the shares can do a lot regardless of actually the external environment.
Yeah, absolutely, and I think that's core to the strategy within the Strategic Microcap Investment Trust, and what we found now is we've done the hard yards on some of these companies like Fire Angel, and ones that have been through turnaround, and actually they've come through COVID quite well, and you then look at their historic earnings and where they were getting back to in their historic earnings, and you just think that they really are exceptionally cheap. and they've got fantastic niches in the markets that they're operating. So yeah, it's very much our modus operandi. And we look down the portfolio now, and we've got the right management teams in the driving seat. You know, look at things like Digital Box, where we've got new chairman going in, freshening up the overall acquisition strategy. You know, that really is what we like doing, and you can get some fantastic returns out of it. It's not quick, but if you get the earnings going in the right direction at the same time as you get a tilt more towards value and small cap, that's really nice.
And have you got enough bandwidth to do all of this sort of like active investing? Because I mean, I do a bit myself where I can, and frankly, it just becomes so absorbing, the amount of time and effort. I mean, admittedly, you guys put a lot more money than I do in it, but it does involve a lot of heavy lifting.
Yeah, and it has done over the last couple of years, definitely. But there, you know, there's not just me. There's a heavy squad behind me of 4 people. So we're spending quite a lot of time with these companies, and it's a real privilege to be able to do it. To be honest, these are cracking. You know, look at Ramsden's and EKF and others. You know, these are quality businesses. Yeah. And it's not difficult. We don't really need to do too much now. We've done the hard yards, and we let the management teams get on with it.
Yeah. Another one is sort of like, which turned around, which will seem to be turning around, is Fire Angel, because came out with a good trading update this morning. Shares are up, actually, looking at the screen, 29%. So well done, Judith. It's good Christmas present.
It's about time. It's about time. I mean, this one's had every turn of corner, it seemed to find a banana skin. And these are great. You've got regulated markets that are growing. So they're selling smoke alarms and CO alarms. There's lots of regulation coming in. And then you've got housing authorities that are obviously reacting to the Grenfell fallout, and quite rightly too. So they have got some fantastic IP, and it doesn't take much to do the numbers on it. So one of their new contracts, is with Ealing Local Council. There's 16,000 properties there. They all need a connected solution for smoke and fire alarms, and they're at £225 per property, and then they'll get £1 per month reoccurring. So, you know, just do your own numbers on the market cap of the company. It's a business that is doing between 40 and 50 million turnover, just selling smoke alarms and B&Q into trade and Screwfix. So you layer on that extra ability of the connected home side, and it looks stupidly cheap. But it does come with a caveat. It's had a lot of legacy issues. The chairman, exec chairman, went in probably about 2 years ago, and he's had a hard job tidying up some of those legacy issues. So we're now just hoping, touching wood, that he's got sorted everything out and is now on the path, as he's just announced today, that he's got growing top line, growing margin, and some really interesting projects that are coming through on the housing association side. So still a bit to do there, but he's going back to that point, he's done the hard yards.
Yeah, I mean, if it moves more in towards the sort of remote monitoring, the smart home, I mean, I remember looking at sort of like, I think it was alarm.com about 2 years ago, and I don't know what the multiple is now, but it was about 10 times sales, because it was a purely subscription basis where it would monitor domestic or houses, you know, their own sort of burglar alarms, and this is a smoke alarm. So if they can get into that sort of like, I mean, I was looking compared to I think the multiple on sales, even now, it's only sort of like 55% of sales, so it still hasn't got any all that's upside, the ongoing recurring revenue stream.
Yeah, it's not counted in at all, and you know, rightly so, because it's a company that has tripped up in the past, and these contracts are only starting to come through. I think the Ealing contract was really only announced at sort of mid-COVID, so people have not really been paying attention to it. Yeah. So it's still a bit to do there.
And how long are you patient for these businesses to turn around? Because I remember looking at Fire Angel, I can't remember what it was called, but I bumped into a professor at Warwick University back in 2003, and he was saying, "Oh, it's a spin out of Warwick University," which I think it is originally. But that's 20 years ago, and you just say, I think it's probably still around about the same price. And so it takes a lot of patience and a lot of effort to get the business into the way, and you need to have a pretty big thick skin to get through it.
Yeah. I mean, we've not been invested for 20 years, but it feels like it sometimes. And they started as a spin out, so 0 turnover, and then went up to sort of 54 million turnover within quite a short period of time, and then they just had these growing pains. So yeah, we've been invested now for about 3 years or so, 3 and a bit years. And we always say that our investment horizon is anything between sort of 3 and 7 years. So that gives you an idea as to how patient we are. But if something had fundamentally changed in the business, we didn't trust the management team and didn't see the opportunity, then we would have binned it. But the regulated markets, it's a gift. That allows a 40 to 50% margin, and you know where your growth is going to come from. So as long as they get the operational side right, then it's happening.
Yeah, smoke alarms regulated. Grenfell, I mean, it needed a whole real look, didn't it? Another one you touched on earlier on was Ramsden's, which is the sort of the financial services and pawnbroking and sale of jewelry and all this sort of stuff. And it's still obviously relatively cheap going into sort of the third national lockdown. It's got a lot of cash on the balance sheet, so it doesn't seem to have any sort of financial distress. And I only raise this one for investors because along with all the others, it seems, it's trading on about 8 times trough earnings or EBITDA, etc. And it should come back strongly next year, shouldn't it? In terms of the foreign exchange, where it makes high margins, people going on holiday, all that kind of, the shops opening for starters.
Yeah, you can look at it both ways, because clearly they're selling jewellery. They trade gold. That's quite defensive. And then on the flip side, if you believe that everybody's going to be desperate to get on holiday next year.
Well, we are. Well, I am anyway.
I am. Yeah, I'll be there. So, and the demographics great as well, where they're situated. So, for the pawnbroking side, and it's historically traded when it was at a discount to its peers on 12 times. And as you say, it's on far less than that now, and it's got 60 million of cash.
Yeah.
And it's a very well run business, and its shops are still open. There's something wrong there, isn't there?
What don't you like? I mean, the one thing which sort of puzzled me at the time was sort of like, competing against the likes of the world's biggest online flea market, eBay. But when you think about it, I mean, correct me if I'm wrong, but when you think about it, who's going to send valuable jewelry through the post? And who's going to buy it through the post online? Because it's all you've got to justify it genuine and authentic and all that. So presumably it isn't. With actual physical presence, it isn't going to get sort of interneted out, is it? I guess.
Yeah, I mean, they do have an internet solution themselves, and they are looking at that more and more. But you're right, people physically want to go in and keep hold of their Rolex as opposed to posting it off. And there's obviously a correlation between the client that's coming in and using the pawnbroking side and also the jewellery side too. It's quite a fascinating business.
Yeah, I mean, if I was buying a big sort of spending £1,000 on a second-hand Rolex, then there's no way I'd buy it online. I'd want it absolutely sort of authenticated before I did.
Yeah.
So and another one you mentioned again earlier on, Flowtech Fluid Power. I think it's Roger McDowell again, isn't it? It's sort of
yes, it is. It might be. Yeah. Here's a trend here. Yeah.
Exactly. Yeah. And another one which is cheap, but it sort of like distributes and services sort of mission critical parts and fluids and pneumatic components, doesn't it? Apparently.
Yeah, it's a kind of Amazon for industrial. Yeah. So it's been a bit through. This is another kind of self-help story as well. So they've taken, I think it's 2.6 million in cost out and got another 2.4 million identified, ready to go. So you've got a de-gear story. It's on about 6 times recovery earnings, whereas again, historically, it's double that. And you've got a management team there that are clearly, they're men with plans. They're not just going to sit on it and wait. So normal market multiples would be well over 200p.
Yeah.
But, it's got a little bit of work to do yet.
And
it's got a good shareholder list as well.
Yeah, and I guess the barriers to entry to this sort of thing is because it's critical parts, and these parts need to be absolutely installed absolutely correctly. They can't have sort of like your normal local jobber coming in and putting in a sort of like, I don't know, a nuclear safety valve or something like that. And they've all got to be, sort of like hugely reliable, etc., and installed and serviced correctly. Then that expertise gives them that barrier to entry, because there's no way anybody can do this unless they've got the expertise and knowledge.
Absolutely. Yeah. Once you're commissioned into something, whether it's in automotive or industrial or aviation, then you tend to be quite sticky.
Yeah. And then a couple you've just recently sold, just Pennant International and Science for Sport. Can you just take us through those decisions? I mean, I think I probably know, but
well, Pennant actually, I mean, we still got some in other funds, so we really like the business. We in the investment trust, we just felt as though there was other opportunities that would probably deliver quicker. The problem there, I think, is the lumpiness of the contracts. I think the management team have done an amazing job in financing their cash flow and working cap. You've got their biggest client basically paying in advance for their projects, which shows you how important they are to that client. So I just felt the lumpiness there was probably going to cause more short-term issues than anything else, but a cracking business that we're holding elsewhere for the longer term. Science and sport, slightly different, I'm afraid. Great brand, good market presence in a growth sector, so there's a lot to like there. But I think we had hoped that the management going through COVID would turn their attention a bit more to return on invested capital. And we just really don't have the confidence that they've got a good discipline when it comes to that capital management side. And I think couple that with our inability to make any changes on some of the incentives. So management team are picking up £1 million in stock options every year. And so that kind of tells you that they're only motivated for top line growth as opposed to maybe what we would regard as good capital allocation decisions. But no doubt we'll get proven wrong and it'll get taken out for a great multiple because it is a good brand. But we just couldn't live with it day to day, knowing that actually it was just going for growth as opposed to going for profits.
Yeah, it's endorsed by some pretty significant sort of sports guys, isn't it? And sort of like Sky Cycling or Ineos Cycling and a whole bunch of others. But to actually get scale in that sort of stuff rather than just being a niche, it becomes quite a difficult proposition. You have to get distribute. You have to invest a lot of money to get that.
Yeah. You're paying for your distribution, really, aren't you? Yeah. That's where the cash is going.
Yeah, and another one sort of like to put on the watch list. I mean, Adept Technology, which is a sort of the managed IT services. Obviously, it's done a great job helping schools in terms of and the NHS in terms of moving into the cloud and still working during the lockdowns. But it's been hit a bit by sort of IT projects being delayed. Presumably that those delayed projects aren't cancelled and they should come back next year.
Yeah, absolutely. And the share price has been hit quite hard on it. And if you look at trade, so there's been, I talked about private equity and where there's pockets of heat, if you like, at the moment. And this is one of the areas. There's quite a few buy and build. I think there's 20 odd buy and build vehicles out there, whether it's private equity or public equity. And you look at the multiples that these types of companies are going on, you're looking at sort of 12 to 14, 15 times EBITDA. And this one's sitting on, well, probably half that. So you've got that kind of optionality, but on the other side, I think there's a degree of cynicism around it because of the debt levels. Now the debt is very well serviced because it's cash generative, and you've got these reoccurring contracts. You've got quite sticky revenue. So you could even just take a view that if it de-geared over a couple of years, then you get the de-gearing coming through, and then you're looking at a kind of 350 share price, or you look at trade and it's over £4. So it just looks wrong, and you don't have too much risk associated with it. It's also quite well owned by the family, so something's going to happen with it at some point. So it's one that we're quite happy to. In fact, we picked up some more stock in it the other day. It was announced. So it's one that we're happy to continue to hold.
And I guess Downing is sort of encouraging management to carry on deleveraging and reducing the debt.
Yeah, it's always an ongoing debate. Yeah.
Another one which actually doesn't need any spare cash, because that seems to be a current theme with most of the sort of the Downing stocks, is that they're well cashed up. Is EKF Diagnostics, who I know Chris Mills very much. He sits on the chair and likes, and Andy Brough likes as well, and has done a great job in terms of that. That business, superb shareholder returns. What do you see there? I understand they've got even another spin out, Trellis, coming through next year as well.
Yeah. I mean, the forecasts are wrong.
Yeah.
you just and even the analyst sits there when we were chatting away to him and looking through, and he admits that he's not put anything next year for anything related to COVID. And you look at the core business, the hematology side and the testing side itself, and actually you'd have bought that every day of the week up to sort of 45, 50p. And then you've got 20 odd million of cash that they're going to do something with.
Yes.
It's doubled earnings this year. And does COVID disappear overnight? Does testing disappear overnight on the 1st of January? I doubt it. So, and then there's antigen testing that's coming in as well. So I think
antibody testing.
Yeah, antibody. Yeah. So you've really got you've got optionality here once again. You've got the IP from Renalytics, you've got the new IPO that's coming through, you've got cash in the balance sheet. Is it going to be a special dividend or is it going to be an acquisition? And you've got more earnings upgrades coming through. So Yeah,
They seem to have this. They seem to have this symbiotic relationship with Mount Sinai that keeps sort of like, you know, creating new businesses that seem to generate huge shareholder value for Mount Sinai and for EKF. So
yeah, it works.
Yeah, it's a good link, isn't it?
Yeah.
And then another one which seems to be well, so it's just bought. It was cashed up when we last spoke, and just bought is Volex. Now, quite an interesting one, I guess. It's just bought a big Turkish, I think it was distributor of sort of power cords and stuff like that, and which looked very, very cheap and good synergy values in terms of scalability. But then this sort of finance director surprisingly stepped away at the same time, which seems. I just don't know how you view those. I mean, I know you probably can't talk about it, but how you view those type of situations. How do you find out? You know, how do you get comfortable in terms of one's really good and one looks less good?
Yeah, and the share price should have gone up by 30-40% on the day, because that deal was cracking.
Yeah,
It's
exactly.
Free cash flow coming out of it, it's going to have about 40 million free cash in the next year or so. So the metrics, you know, they've proven that they can buy cheaply, integrate, take synergies, and then get the benefits of their own distribution. And so from the fundamentals point of view, we love the deal and we love the progress that the company's made. I think, you know, we've followed this business now for 4.5 years, probably longer actually. And when we got involved in it, I think it was about 40p, and everybody hated it. It had 10 management teams through 8 years. It'd been low margin. It wasn't an attractive business.
It's nearly £3 now, just looking.
I know. And so it really is, it's the epitome of what we talked about earlier, and, you know, getting involved in businesses when nobody cares about them really, and where we can, helping management teams through that path of turnaround. And, you know, in fairness to them, they went from negative margins up to where they are now, 7 or 8% margins, and they've done what they've said. But as part of that journey, I think management teams do have to evolve and change. And we've got a tremendous amount of respect for Darren, the FD who's departed, and he was instrumental in a lot of the early work that went on in that turnaround. But, you know, people move on and they want new projects, and they, you know, sometimes businesses grow bigger than the people were, and sometimes people like being entrepreneurial in small mucky businesses to do the same thing again. So I don't doubt that we'll see Darren turn up at a show near us at some point. And, you know, it's a good solid management team that he's left behind. So you're right, it's always a bit of a eye opener, and you've got to get comfortable, but, you know,
yeah,
it's a solid business.
Once you can square the circle on these type of things, then it's sort of the picture falls into place, and it's sort of. But there are occasionally things, news flows which come out, and you can react the wrong way. But it's yeah, I mean, the deal looked absolutely cracking in terms of, you know, well within good investment for on the cash, good excellent synergies. In fact, the synergies will probably pay for the acquisition within about 3 years.
Yeah.
You'll be back to where you were. So pay for itself. Another one where you've still got I guess Downey has still got the gloves on, doing the dirty, doing all the dirty work, is Synetics or something, because it's still going through a tough patch with its self-help, and also with casinos being shut, I guess.
Yeah. I don't think we need to do much on that one actually, because the management team have done. I think they came out with their statement a couple of weeks ago.
Yeah, did you?
Over lockdown, they not just over lockdown, but they'd started the process of basically tidying up the cost base. So there's about 2.2 million of costs come out, and on an annualized basis, which is great. So you can therefore see it quite easily getting back to £4 million of EBITDA, and that's without. And I think they've reincarnated themselves a little bit over the last couple of years too, because they won that massive Deutsche Bahn contract. I think it's about £9 million or so, and that's for surveillance of railway stations and networks within Germany. And that is much more of a solution sell. So systems, 45-50% type margins. They've got a little business, the IMS business, which is a bit of a kind of box shifter integrator that's on really low margins. So they've taken quite a lot of cost out of that. So I think net, you're going to see the margins kick through quite quickly now. Yeah. And you're not as dependent on gaming. Gaming will come back at some stage, but you've now got these, I think they allude to it in the statement, that their whip list is more of the system, infrastructure, transport nature than just gaming. So 40 million of turnover coming back from gaming is a really nice kicker, but they don't need to bet on it. So I think they've actually, we've not had to do very much there. They've done it themselves, which is great.
Yeah, and where Downing does have to, did you actually put any directors on the board at all ever? Or is you basically prefer just to do it sort of like off the PLC board?
Well, what we like to do, and there's been a lot of board changes in some of these companies, and I think Synetics has had one or two. I can't quite remember now. There's quite a number throughout the portfolio. But what we want to do is show our black book of what we regard as good companies and get the management teams to buy in themselves. The worst thing that you can do, unless it's in a really distressed situation, is turn around and say, well, this is our man or this is our woman, and they're going in. If you can introduce good people, if you can help in the process, we use new role quite a lot and introduce new role to our companies, then actually that, where you get the buy-in from the board and a good management team, that works really well. So all we're doing really is providing a bit of a Rolodex. Or sometimes when we need to get more activists in, we might be a little bit more forceful with that view.
Yeah, and then finally on the portfolio is Universe Group, which I think does sort of like retail management solutions and payments and loyalty systems and stuff like that. So I'm guessing it's reasonably sort of proprietary software, isn't it? It should be doing quite well, I would have thought.
Yeah, again, they've probably had a little bit of a downturn because they needed to get on site to do these installs.
Yeah.
But EPOS systems and point of sale for fuel forecourts. People don't want to go into the stations anymore. So they have some really good rollouts for the likes of Morrison's.
Yeah.
They need again to become more of a solution sell as opposed to a box shifter. But they've got the opportunity to do that. And I think the pent up demand that they've had from their delayed pipeline is pretty good. And again, it's one that there's been a lot of consolidation going on in that industry over the last 3 or 4 years or so, both by private equity and by trade players, international trade players. So it's got to be something that's in play at some point. Yeah,
it sounds like you probably could have a sort of like an army of sort of M&A activity going off next year. There's about 4 or 5 of the
well, I think so. Yeah, I think there's definitely the opportunity, and I think our view is, and management's view as well, is that if you're not getting valued properly by the market, then you've got to look at other solutions. You can't just bet on the stock market giving you the valuation that you think you deserve. You've got to work quite hard for it. Yeah, I think these management teams are well incentivized to do it. That's the third part of it.
Yeah, and then again, just finally, I think you've got sort of like a 10 or 15% cash holding within the portfolio. What are you looking to how are you looking to deploy that? What sort of time scales? I mean, you could almost just buy your own stock back, couldn't you? Albeit you probably don't want to, but in terms of sort of like looking at opportunities to redeploy the funds.
Yeah, so we've been quite busy. If we look back, actually, since COVID started, we've made 5 investments in the trust. We can't talk about all of them yet, but we've talked about some of them. So we're going to top up some of those ones, some of the toeholds, and we've got a nice little whip list that we're watching carefully. And we're just literally waiting for the right time. We've got a little bit further due diligence to do, but we know where to spend the cash, but we want to do it on a day when the market's maybe a little bit more pessimistic than optimistic.
Okay, so we'll look forward to hearing some of your New Year sales, shall we? In January. Okay, well, thanks very much, Judith. Another excellent insight into the small cap world and how what Downing looks for. And as I say, I think top level small caps, particularly in the value side, are going to do very well next year. And you've seen it in terms of some of the comeback after the vaccine announcements, but there's still a long way to go. And with a sort of like a mix of pent up demand and the economy coming back and people wanting to go on holiday, I've got a sneaky suspicion it's going to be a good year.
Yeah, looking forward to it.
All right. Thanks very much then.
Cheers. See you soon.
Bye.